Hello and welcome. I'm Suyash Maheshwari and you are watching Last Tick here on News9, where we break down the day's action on the Lal Street. And Indian markets, they have hit a fresh record high once again, with Nifty scaling a new peak for the third straight session. Sensex also managed to end above the 75,000 mark for the very first time, a historic milestone it had achieved on Tuesday. Now the new peak on Nifty is just about 7-8 points higher from the previous record high, but look at the sentiment. It clearly is in the favor of the bulls, and that is indicated by the price charts. We have been forming higher highs, higher low formation on the price charts in the last 4-5 sessions, so the momentum is looking strong, and this buy on dips mantra is clearly working out for the markets. But shifting focus to the broader markets, they are also looking all set to resume the next leg of up move, as both Nifty mid cap and the small cap indices ended with strong gains after 2 sessions. Look at the last 2 sessions. We were witnessing some signs of exhaustion, as both indices were seeing big drops from their intraday highs. But today was different. We ended very close to the day's high on both indices, and that perhaps can be looked as a bullish signal, perhaps a bullish continuation signal. But shifting focus and moving on to the sectors, Nifty Bank made a fresh record high today as well. The index managed to climb above the 49,000 mark for the very first time on the weekly FNO expiry day. But the close was still below that 49,000 mark. I think we just ended about 14 points shy of it. But all in all, it has been a good run for the banking index. Remember, before the last couple of sessions where we have managed to make a fresh peak, the index was struggling around that 48,000 zone, and time again and again we would see a reversal from there on. But once we were able to break past 48,000 in this run up, the move has been rather swift. 1,000-point move in a matter of 2 sessions. So overall, Bank Nifty is perhaps looking like it's on a strong footing now. But other sectors that participated in the up move were FMCG, metals, media and PSU banks. All 4 indices ended with gains of over 1% in Wednesday's trade. But this move that we saw in Nifty FMCG is particularly noteworthy in my opinion, because that has been the pocket of the market that has just not done enough for the investors, right? And a reason for today's spike is perhaps that report that came out from SkyMet, which now predicts a normal monsoon in 2024. And this not only will be a positive for FMCG companies, but other agri-related stocks as well. And remember, this is like rural demand or lack of it has been a big pain point for our markets. So perhaps a normal, normal rainfall could help bring us or propel that particular pocket of the market as well. But joining us in the studio now, in the show now, is a very special guest, Mr. Ambrish Balega. Sir, good to see you after a gap of couple of weeks, and it's a great time to have you as well, because Sensex has claimed a historic feat, climbing above 75,000 for the first time on Tuesday and closing above it for the first time today. Now I remember when Modi led BJP first came to power, we were somewhere around that 25,000 zone. We have tripled since then, growing at a CAGR of about 11.7% over the last decade. But if the index does manage to continue growing at the same rate, we should get to the big one, the 1 lakh mark, in about 2 years, 7 months from now. The question really is, Mr. Balega, can we get there earlier, perhaps by the end of calendar year 2025 maybe?
No, that's possible to a certain extent, because clearly, if you're investing in the market, the general expectation is that you should be getting about 15 to 16% CAGR, which again means that the index should move at about 10 to 11, 12% CAGR. So the level which you're talking of is very much possible. It could be plus minus a year and a half, because in case we have some deeper correction in between, then I suppose it could take a bit longer. But then if you're talking of India long-term story, with a stable government like what we have had in the last 10 years, I think reaching those levels should not be too difficult.
All right, and I mean, in this latest 5,000 point surge on Sensex, which by the way just took about 81 days, the fourth fastest in the history of Sensex, 10 out of the 30 stocks delivered negative return. I mean, does it make more sense to invest in these stocks? 8 out of 10 of these stocks are from the banking, financials and FMCG space. Both these sectors have not done much for the investors in the last 12-15 months. Also, SkyMet is expecting a normal monsoon this time around, perhaps making a smaller case for FMCG companies, sir. What's your take on this?
Absolutely, because if you look at the FMCG companies, they have underperformed the market overall. If you see the last 12 to 15 months, and I mean this time, like there was a doubt whether we would have a normal monsoon, because if it's a normal monsoon, if I'm not wrong, would be I mean eighth time in a row, which is quite difficult. I mean, generally when you expect the monsoons, I mean that like you may have 1 or 2 years of bad monsoon, and then at the 4 5 years of good monsoon, but then 7 8 monsoons in a row being decently good, it's quite difficult to really expect. But then, in case, I mean, since now they're saying that possibly we'll have a normal monsoon, I think that's extremely positive from the market perspective as far as the FMCG stocks are concerned. So I think stocks like ITC, Dabur, Britannia, HUL, I think these are stocks which should actually do decently well, because most of their sales also come from the rural region.
Sir, while we all have been focusing on what's going on at the two ends of the spectrum, the headliners and the small and the mid caps, Nifty Next 50, which consists of 50 companies that are next in line to be included in Nifty 50 index, that has been the best performing index of 2024. In fact, Nifty Next 50 just notched its best quarter since 2009. I mean, are these the stocks to consider buying, since they kind of offer kind of offer best of both worlds, stability of larger companies and growth potential of mid and small size firms?
No, but then see, since they've already performed to a very large extent, I think it's better to look at the stocks or sectors which haven't really performed too well and expected to perform, just like what we're discussing about FMCG. I think that's a much safer sector to invest in. I mean, unless you're a trader. I mean, if you're a trader, then I think you should look at this Nifty Next. I mean, basically the mid cap part of the market. But then, if you're not a trader, if you're an investor, I would suggest, I mean, one should be looking at the sectors which had not done well in the past, but expected to do well. Because these are the ones which can actually give you extremely good performance. I mean, just to give an example as to how defense, the PSU banks, I mean, all these sectors were written off, were not doing well about 2 to 3 years back. But those who bought them really made multi-baggers. So I'm not saying you'll have multi-baggers in FMCG like the way we saw in defense, because that was a fresh discovery. FMCG is not a fresh discovery. But I mean, I think these sectors can give you better than market returns, and they're safer at this point of time.
All right, perhaps it makes more sense to invest in sectors that have not really participated in this tremendous rally that we have seen playing out over the last 12-15 months. But so far, Mr. Baliga, the market has pretty much ignored the global headwinds coming our way. But with crude prices, bond yields in the US and the 10 and the dollar index holding steady at multi-months high, do you think it's time for us to factor that in, or is it already absorbed at current levels, sir?
No, see, I mean, there are a lot of red flags on the horizon, but then I think the markets currently looking at the sentiment is ignoring a number of red flags. I mean, we also have geopolitical issues which are there. You have an election on hand over the next 2.5 months, where I think the best of the results is already factored in. So there is possibly, I mean, some chance of a disappointment out there. I'm not saying that I mean this government will not come back, but the numbers which have been discounted is about 400 plus. So in case we don't reach those levels, there can be some amount of disappointment. We are in fact getting into earnings season over the next at least 4 to 6 weeks. We'll be having the earnings season. I mean, it's very much possible that we could have certain sectors disappointing out there. I mean, we have seen some headline numbers coming. I think decent number. I mean, decent ones. I mean, have been good, quite. But then at the same time, we can have some disappointment there. So I think one has to be a bit careful at this point of time. I would say keep at least 1 foot in the exit door, but then just keep it at the back of the mind that most of the good news is already factored in.
All right, most of the good news is already factored in, and perhaps we should, start paying attention to some of these global headwinds that are coming our way, and there are enough and more reasons domestically as well for us to worry. But there is one particular stock that I wanted to pick your brains on, and that is Vedanta, which by the way surged to a 2-year high after CLSA upgraded the stock to buy and raise the target price by 50% to 390 rupees per share now from the earlier target of about 260. I mean, from current market price, that's about a 7-8% upside, factoring in the strong up move we saw today as well. But CLSA, sir, expects Vedanta to benefit from this commodity upcycle considering its diversified portfolio. But I mean, for investors, the problem with Vedanta really has been the high debt on its books, right? More importantly, its ability to service that debt. So I mean, they do plan to reduce that substantially at the parent level without, by the way, taking any incremental debt at the Indian, on the Indian entity front. All that said,
Absolutely.
what's your take on Vedanta, sir? I mean, is that a stock to consider, buying?
It can be considered for buying because, see, I think one of the major reasons for the stock to underperform in the recent past, like you rightly mentioned, was the debt burden. But the management has been able to push the maturities of this debt, and most of the maturities have now gone to FY27 and beyond. So, which means that you have enough time to pay back, and at the same time, we have seen the sort of cash flows which Vedanta has and the sort of dividends they pay. So I suppose this debt burden issue has been pushed at least for a while, which is positive. Now look at the sort of businesses which they have. I mean, if you're talking of aluminum, they are the largest producer in India. Hindalco is not, but Vedanta is the largest. It's for have a 45% market share. Talk about zinc, lead, silver. I mean, here they are again the largest producers. They have a 80% market share. Oil and gas is the largest private sector oil producer in India. And if you're talking of iron and steel, they are one of the largest in the private sector as far as exports of iron ore is concerned. Power, again, more or less the second largest player. And if you're talking of copper, they have one of the largest smelters. So across the segments, they are leaders. And like you said about the CLSA report, yes, the commodity upcycle has started. And in that, metals is expected to perform. And if you're talking of Vedanta, it's across its metals. And if you look at the last quarter results, Q3 FY24, they had the highest ever your third quarter consolidated sales, and EBITDA was about 21%. I mean, what I mentioned just some time back about the sort of cash flows because of which the sort of dividend yield which they have, I think that's one of the best. They paid, I think, 29.5 rupees as dividend for 9 months, and now Q4 is remaining. So that should, in fact, increase from here. And at the same time, they're trying to reduce debt by selling off the non-core assets, which again is positive. So if you look at the next 1.5, 2 years, I think one of the major triggers for the Vedanta shareholders would be the proposed demerger. Because whenever there's a demerger in any group, I mean, that's a sort of a wealth creator. So, I mean, I had a price target of 320 earlier, but then about 3 days back, we increased that target to 408. So there's still some more upside.
All right. I mean, over 10% upside if you are to go by your price target of about 408 on Vedanta. I mean, overall, I think we all can agree it's better position now, especially on the business front as well, and with the talks of demerger as well. They are planning to spin off multiple businesses, and let's see how this jet situation also pans out. But FY25, sir, has been off to a flying start. I mean, if you really think about it, in the last 2-3 years, the real rally the markets have been post April. The first 3 months are typically weak for the markets, but we are in an election season. What should be the strategy for the next couple of months for investors out there, and what asset classes should they spend spread their money across at this point?
No, asset class, I mean, the only asset class which I really understand decently well is equities. So I would normally say that one should have more exposure to equity if one is able to take that risk. But like I said some time back, I mean, keep at least one leg in the exit door because it's an election year. I mean, anything can happen in an election, and the best of the results is already discounted. So just keep that in mind. And in case we see this rally continuing beyond July, I mean, I'm talking of post-budget, then possibly, I mean, one can think of again getting reinvested fully. But till then, at least, I mean, keep some cash in hand. I mean, you've made decent profits in the last 1.5, 2 years. Take some profits off the table. I think keeping about 20% in cash would be advisable at this point of time. I mean, I'm never saying that one should be exiting fully. You can't exit the markets fully, but at least book some profits.
All right, keep some cash in your portfolio, and maybe that fresh deployment of funds should only come post July when the budget is done with. That's the word coming in from Mr. Amrish Baliga. Sir, thank you for giving us time here on News9. Always great insights from you. But with that, it's a wrap on this edition of Last Take. We'll see you tomorrow at 9:45 a.m. on First Take. But up next is Business Plus.
India's ever-evolving urban landscape is witnessing a new revolution. And this one comes on 4 wheels.
The affluence has been growing. Cars are becoming more a reflection of what you are.
Nobody's talking about hatchbacks. Now what next? The next is the SUV.
The contribution of SUVs is close to 55-60% of the automobile sales these days.
Is that even manufacturers like to sell SUVs?
So, how did a nation obsessed with fuel economy come to love heavy gas-guzzling sports utility vehicles? Let's look at how India fell in love with the SUV.